Maybe we have it wrong here in saying that the market is paying attention to the trade wars, because if it was, why wouldn't it be lower? Maybe it's paying attention to something completely different.
Well, you know, we saw today the fundamentals were really what was moving the market. The jobs report moved it much more so than the tariffs and the trade issues did. But I think a lot of that is because what we received as far as the tariffs was what we had expected. There wasn't a large surprise there. But when earnings start to come out next week, we may see what we saw during the first quarter. You know, we had really strong earnings the first quarter, and then it was the guidance of the companies that came out, that negative guidance, that really made stocks not appreciate the way that we thought they would. And we could see that again on this quarter. Again, earnings expectations 18 to 20%. But if guidance comes out that employment is going to be an issue for these companies, CapEx is not going to be what they thought, then we can see some concerns moving forward and have tariffs really play a more important role.
And if trade becomes the new weather, an excuse for performance.
Exactly.
So, Eric, let me turn to you. As you look to the earnings quarter that will start coming out next week, what do you expect in terms of growth, and what do you expect over the next, say, 12 months? And are stocks priced to reflect that?
So, Tyler, we see a 28% earnings bogey basically baked into markets for the next 12 months. In other words, that stocks really have to deliver that kind of growth to justify current multiples. So, to that end, we think that next quarter will certainly be important. And as Victoria mentioned, guidance will be key. So at a 28% growth rate, that puts the S&P at about 16 times earnings, which is certainly not lofty. But if we start getting into a little bit of a game between 34 billion and we start moving up in increments of, call it, 20 or 30 or 50 billion beyond this in tariff talk, that really is not priced in. And if you certainly factor in what President Trump mentioned last night, which is a potentially an upper bound of $550 billion of tariffs, that is nowhere priced in the stocks, the dollar, really anywhere. So those are things we really have to keep paying attention to.
It wasn't priced in, and it wasn't priced in when Trump mentioned it yesterday on his way to Montana, Victoria. I'm curious, at this point, what seemed to be very important in the jobs report was that wage inflation wasn't too hot. It allows the Fed to keep on its track of rate hikes without the worry of an overheating economy. And then you layer on top of that the inflationary impacts of tariffs and then the potential drag on growth from the overall tariffs as a whole on the economy. I mean, it was sort of a Goldilocks economy, Victoria. So are you concerned that perhaps going forward, we could be in a situation where inflation could pick up and then we have stagflation? I mean, if we haven't priced in $500 billion incremental goods, and that's basically every single thing we bring in from China, I mean, that's a pretty big impact on growth.
It is a large impact. And I think, the Fed has a little bit of room to run because we don't have those inflation pressures in there right now. You look at the neutral rate on Fed funds, it's between 2.5%. And right now we're in the low 190s. So even with 2 more Fed hikes, which we anticipate we'll see this year, you're still in that neutral range. And there's no need to really move above that at this point in time. And I know there's concern that, we're going to have an inverted curve, but people have to remember that an inverted curve is not the causation of a recession. There is a correlation there. But we do need to watch the growth numbers. If you look at China's exports to the U.S., it's 4% of their GDP. But a lot of that actually is in that supply chain to other emerging markets. You've got Malaysia, Singapore, Taiwan, Korea. And if you add all of those together, that's 20% of your total global GDP. So there's definitely some concern that this could feed through and be a much more broader concern on the growth front than what we're seeing right now. But currently, the Fed has a little bit of room to run because we haven't seen that inflation pull through yet.
Eric, the scouting report is that the industrials would be among the multinationals are among the hardest hit when we get a trade war. They were born and grown during a time of globalization. But as the pendulum swings the other direction, do you look less at the industrials, or did they become a buying opportunity for you here?
Tyler, they certainly could be. We think that the mix shift that perhaps China may pursue, if there is ongoing back and forth, could cause some price dislocations in industrials. We also would look at technology being a particular bargaining chip. Of course, that's been a sector that has a ton of rhetoric back and forth between the U.S. and China. And given a lot of the growth baked into estimates is really focused in a few technology names and a couple subsectors, that we think could be the next area of focus. So we'd pay attention to industrials, absolutely, but we do think that technology is one of the key things to focus on if that tariff mix shift really happens.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.